So we are going to run the country until such time as we can do a safe, proper, and judicious transition.
Hello and welcome back to a new year with the week ahead on Nomura Podcasts. I'm your host Dominic Bunning, head of G10 FX strategy in Nomura's London office, and today is Friday, the 9th of January. Well, 2026 has started with something of a bang with the news on the 3rd of January that the US had removed Venezuelan President Maduro in a swift military operation. And in President Trump's words, as you heard at the start of the pod there, the US plans to exert significant control from here, particularly over the country's oil production. Markets are pondering the potential knock-on effects of this new Don Roe doctrine, whereby the US administration looks to exert more influence over what it sees as its hemispheric interests. The near-term market reaction has been somewhat subdued, with equities generally in the green year to date, most bond yields chopping around within recent ranges, and the US dollar marginally stronger since the turn of the year. We'll be discussing some of the macro implications of this with our senior US economist Jeremy Schwartz shortly. And we'll also be looking at the latest US labour market data released just a few hours before we recorded this podcast, which still show some decent resilience. We'll also look at US inflation data due next week, which is going to be very crucial in determining the next policy steps from the Fed. Moving to Asia, there's still a focus on how the AI theme can impact economies in the region. South Korea is front and center of this, so we've got Jung-Woo Park, our economist for the region, to talk through their latest report on that, as well as to preview the upcoming Bank of Korea meeting. We also speak to George Buckley on the latest developments in the UK and Euro area, especially regarding UK activity data and Euro area inflation. Before we get to all of that, though, I want to flag our 4 year-ahead podcasts covering the US, Japan, Europe, and Asia, all released over the holiday period. If you haven't got round to it already, they are well worth a listen, so please do have a search for those to get a longer-term take on what we expect in 2026. With that all covered, let's get stuck into this week.
We're going to have our very large United States oil companies, the biggest anywhere in the world, go in, spend billions of dollars, fix the badly broken infrastructure, the oil infrastructure, and start making money for the country.
Well, we're going to start this week in the US, where all the action is, with our senior US economist, Jeremy Schwartz. Jeremy, thanks a lot for joining us. We'll start a little bit on the politics. Clearly, this news around Venezuela and maybe the knock-on impacts, what it might mean with other geopolitical tensions is in the center of the focus for markets. We've heard Donald Trump already on the podcast speaking about how the US may continue to impose a fair amount of control on the Venezuelan economy, particularly the oil market, for example. Is there any real prospect that these events have much impact on the US economy in the months ahead, or is it a sort of something that won't really drive macro developments in your view?
Hey, Dom. Yeah, thanks. And it's great to be back on the podcast. So in our view, this is unlikely to be a major factor for near-term macro. For starters, there just simply isn't that much oil production in Venezuela at the moment with the deterioration in their infrastructure. That said, getting access to those oil reserves and potentially unlocking them in the future does have implications for the future outlook for oil supply, and particularly the I would say, cutting off the right tail risk of a sharp increase in oil prices in the future. Beyond the macro itself, it does seem as if this episode has emboldened the administration a little bit. You have the discussions about Greenland, you have some saber rattling on Iran. So I do think that, as is often the case, second-term presidents often pivot to foreign policy, and we can expect more headlines along these fronts from the Trump administration going forward. But as we said, in the near term, it's unlikely to be a significant factor for commodity markets, for U.S. growth or inflation, and it's more about kind of unlocking supply for the future.
Yeah, I think that fits with kind of the reaction we've generally seen in the markets as well. I mean, just from my perspective, it's quite interesting that shift to foreign policy, whether the international markets take as a dollar positive or a dollar negative, around how people interpret the US administration, what they're focused on. So I think that's something to watch going forward. But right now, not necessarily any strong direct conclusions. I think we could probably make bigger news out of the latest job data, which came out just a few hours ago from where we're recording this. From my perspective, it looked like the data seems resilient enough. How are you guys interpreting the latest numbers on the US labor market?
Yeah, so I think the December report was some reassuring confirmation that some of the weakness in November was just noise. So in particular, you saw the unemployment rate tick lower to 4.4. You had the November print actually revised lower for the unemployment rate, as we had flagged in some of our previews. And you had a decent enough NFP reading at 50K, so slightly below consensus, but I think still very consistent with this stabilization that we saw in a number of indicators late last year. That said, I would classify this data as good, not great. So even though some of the November increase in unemployment was just noise, it does seem like fundamentals for the unemployment rate are remaining kind of a little bit lackluster. So I would say there's a lot of evidence that layoffs have remained very low, and that's positive. That's telling you that you're not deteriorating in the labor market. But today's report really showed that there's been no turnaround in hiring or labor demand. So we're seeing that the median and average duration of unemployment is continuing to move higher. So if you are unlucky enough to lose your job, it's taking longer to find one. And I think that's been confirmed in a number of labor indicators recently. We've seen consumer surveys suggest that people think it's harder to find jobs. And you also had a large downside surprise in JOLTS job openings out earlier this week, taking the vacancy unemployment ratio to its lowest level in a few years. So I think it's positive that the unemployment rate isn't continuing to move higher. We do expect it will eventually turn the corner and start to make progress in 2026 back into the low fours. But I think we're waiting for some confirmation that you are getting that pickup in hiring and labor demand before thinking that the labor market has really turned a corner.
Okay, superb. So, I mean, it sounds a similar story to what we've seen for a while, this kind of gradual weakening or slowing of the labour market, but nothing too dramatic or nothing really for the Fed to worry about, certainly for the time being. We move into next week with the inflation data. Do you think there's going to be anything in the inflation numbers next week for the Fed to worry about?
Yeah, so the inflation data is going to be quite noisy, and we're really going to be dealing with the payback of the October and November inflation data for a while, where, as you recall, the BLS effectively assumed no inflation in many components in October when they couldn't measure due to the government shutdown. And then also there was some delayed data collection in November, which we think caused some difficulties with seasonal adjustment and put downward pressure on last month's readings. So we're expecting quite a strong print, 0.451% month on month for December core CPI. That's largely payback from those two technical factors. I think components which are measured every month and which aren't based on BLS surveys are sort of sideways or potentially even somewhat lower going into the end of the year. But we do think that you have a decent way to go to unwind some of that technical distortion in October, November. I'd say this payback is going to be you're going to make good progress on it in December, but it's likely to continue as well and put upward pressure on January CPI, where you also tend to have positive residual seasonality. And then it's actually going to continue all the way into April of next year when housing inflation kind of finally corrects for some of the distortions in October. So again, I don't think that this is telling us much about underlying inflation, but it's certainly hot enough to keep the Fed on guard and to continue the view that was proposed by many hawks last year, that inflation seems to have stopped making progress back towards the 2% target.
Brilliant. So, I mean, it sounds very much like, the Fed view that we've had, which is no rate cuts really in the first half of the year now, very much supported by this view with the labour market not really deteriorating much, and the inflation numbers probably showing a little bit more of a pop. Is that still very much the case?
Yeah, and we continue to hold the view that the Fed's on hold for the remainder of Powell's term through May. We do think that the new Fed chair appointed by Trump is likely to be motivated to cut, and we think the data will give them enough of an opportunity to sneak a few additional cuts in there. We're penciling them in for June and September. But for now, there certainly won't be any urgency to cut, and we think the Fed can make good on their hawkish rhetoric from late last year.
Brilliant. Well, we look forward to seeing how it all pans out in the months ahead, Jeremy. Thank you very much, as always, for joining us.
Yeah, thank you.
We're going to move on to Asia now, and I'm very happy to be joined by Jingwoo Park, our chief economist for Korea, based in Singapore. Jingwoo, thanks for coming on. Look, this week, the main event in Asia really seems to be around the BOK, so it's great we've got you on to speak about it. What are you expecting this week for the BOK?
Yeah, we think the BOK will keep the policy rate steady at 2.5%. Currently, the growth outlook is improving, and today, the government just raised their growth forecast to 2% from 1.8%, and now is the chip cycle is going to be very strong. And at the same time, inflation still above the BOK 2% target. So in terms of the economic outlook, I think the BOK will keep the policy rate steady. And at the same time, the financial stability in terms of the weak currency and the still strong housing market, that's still a big concern for the BOK. So yeah, markets and we expect the BOK to leave the policy rate unchanged at 2.5%.
Yeah, it's interesting you mentioned the financial stability as well. I mean, on the currency side where I look from it, it is interesting that the won has kind of really struggled despite some potentially positive news. I also wanted to touch there, you said around consensus. Clearly, this meeting does seem to be quite a consensus view, but I think if we look further ahead, the consensus does still seem to have further rate cuts in mind for Korea. You guys are a bit different. You guys have got rates unchanged in 2026. Can you give us a bit of an indication as to why you think you're a bit more hawkish than the rest of the street in terms of the BOK's rate path from here?
Yeah, so as you can see from our growth forecast for this year, we are quite above consensus. Our GDP growth forecast is 2.3%, well above consensus, and even the today's the government forecast of 2%. So which means that we think the output gap is going to close earlier than the BOK expectations, which means that inflation will come back in H2. Already inflation is above 2%, but that's mostly because of the supply side, weaker currency. But we think that the domestic demand is going to get stronger, and we're gonna see some, the demand side inflation in H2. So although market thinks that it's only the chip cycle to drive growth, but we think differently. We think that we're gonna see more balanced growth in H2. So we are quite bullish on the growth side. So because of that, we think the BOK is unlikely to cut the policy rate further.
Okay, it makes a lot of sense. And I think, you touched there a lot of, obviously, on the kind of chip cycle. I mean, AI in general has become a massive theme for the world, for equities, for economies, etc., and no more so than Asia. Your team as well have just put out a big piece around Asia as a whole, looking at the kind of exposure to the AI theme. I'm pretty sure Korea comes out close to the top of that exposure, understandably. But were there any other interesting takeaways that you wanted to flag from that report in general?
Yeah, looking at the countries across Asia, we managed to rank countries in terms of the degree of benefit from this strong AI cycle. The US big tech companies, they, the increasing investment aggressively. And the last year, clearly, Taiwan and Korea, the leading countries to benefit from this strong AI cycle. But, as AI cycle is broadening out, we think there are more countries to benefit from this cycle. So we look at the, more like, the comprehensive framework to score the benefit, the degree of benefit for each countries. And we think apart from the Korea and Taiwan, there are also, the Southeast Asian countries, such as Singapore, Malaysia, Vietnam. Certainly, they are also gaining benefit from this strong AI cycle. And looking ahead, we are going to see, the more impact from the this AI cycle, and we also present some framework that in terms of the AI exposure, like by breaking down net exports, the capex cycle. That's the main finding that from this report.
Superb. Well, I encourage everyone who's listening to the podcast, if they can, to read it. I think it's a fascinating look at this topic, which is clearly front and center for a lot of investors. And I think, also really interesting that, yes, we have Korea and Taiwan, which are kind of well known to benefit. But as you rank things, you can see how that theme is actually positively impacting a wider range of economies and in which different ways. So really interesting discussion there. And again, I think the Korea rate path as well this year, even if next Thursday isn't that interesting a decision, looking ahead, I think super interesting that we've got that differential view. So great to have you on, Jim. Thank you very much, and we look forward to speaking to you soon.
Thank you.
And just moving away from Korea within Asia, we do have a couple of other data releases to flag. Next week, we've got exports out of China. We expect those to slow somewhat, but the trade surplus to remain pretty wide, an ongoing theme that we're seeing in China. And in India, we expect inflation to pick back up in year-on-year terms to 1.4% from 0.7% in November. And although we still have some deflation in food and drinks, those should be coming in at a slightly better rate than before. So all in all, there is a little bit more inflationary pressure coming through in India. It's a pretty quiet week in terms of data in Asia. So for us, the big focus is going to be on that BOK decision, as we discussed. Well, we're going to finish this week with the Euro area and the UK, where I'm joined, as usual, by George Buckley, our chief economist for the UK and Euro area. George, thanks very much for joining us. It's going to be, I think, a relatively quiet week in terms of the data, at least when we look to the start of 2026, but the UK probably more in focus than the Euro area for the time being. What is it in terms of the week ahead that you're watching most closely for your next clues about the UK economy?
Well, you're right, Dom. I'd love to sit here and say the start of the new year is we're going to be bombarded by data, but that's just not true. We don't have that much. I mean, I think Trump is helping make up for a lot of that lack of data and other geopolitical interests. But certainly, I think you're right that the Bank of England is a more interesting beast at the moment than, for example, the ECB. If you look at what's priced in for the ECB over the next year, it's very, very little indeed. And in fact, we're not forecasting any move from the ECB and the depot rate. But the Bank of England, I think it's a lot more interesting. We are forecasting another cut. The markets are forecasting or expecting the best part of 2 cuts. So all of the data that we're getting is important, even though it may well be a little bit more second tier next week than normal. So what we've got to watch next week, we've got some retail sales numbers, an important month, of course, there for December. So we'll see whether those BRC figures show an uptick. They had been pretty weak in the previous 3 months. We've got a housing market survey, a lot of questions being asked about whether the housing market is slowing. I think the housing market might be supported by the fact that interest rates, mortgage rates are coming down a little bit. You've got GDP. That's interesting because the last 3 or 4 months, indeed, of GDP have been contractions. So all the way from July through to October. Will November be an expansion? I suspect it will, even if it's just payback. And finally, the Bank of England publishes its credit conditions survey. So that's will be a focus as well, because the mortgage market, there was not much increase in demand, but there was certainly a lot of increase in supply. So willingness to supply mortgage credit according to last quarter's numbers. So a bit to watch, but not the sort of big data that we might be getting towards the middle of the month.
Okay, so yeah, definitely some bits and pieces that will be of interest, and particularly I think with the BOE sort of quite finely poised in some respects, particularly over the exact timing and how much they are going to cut maybe over the next 3 to 6 months, certainly worth bearing in mind. The other thing I wanted to bring up on the UK was some comments, some interviews from Prime Minister Starmer early in the year, sort of maybe talking about the possibility for a closer relationship with the Euro area, or the European Union, I should say. And we've seen this reflected to some extent in sterling. I think we've had a bit of an outperformance from sterling over the last week or so. Do you take those sort of comments with much, or give those comments much credence? Do you think there is any hope or potential for the UK and European relationship to become a bit more closely entwined economically over the year ahead?
I'm sure there is certainly an opportunity to do this, and I think Starmer will seize that. But I think also it's worth bearing in mind that based on what the government said in the manifesto and the pledges not to rejoin the customs union or the single market, I think it's going to be very challenging if we're not willing to accept things like the freedom of movement of people in order to generate anything major economically by increased integration, because the integration itself is going to be limited purely by the fact that we have these red lines. So I think it's a good thing that we are looking to become a little bit more aligned with Europe. That will help, but I'm not sure it's going to be the thing which turns the economy around.
Yeah, I think that seems a fair assessment from my perspective as well. Talking about the euro area or in European Union as well, I mean, we don't get a lot of data coming out, and we've kind of got this relatively balanced position for the ECB in particular. We did just get the euro area inflation data for December and the country data as well. Is there anything within that makes you kind of think the risks on inflation potentially are skewed one way or the other? Is there stuff happening beneath the surface that we should be bearing in mind?
Well, unfortunately, we don't get a great deal of information in the flash prints beneath the surface. We will get a bit more towards the middle of the month when the full detail comes out. But we're looking at inflation rates at close to 2%, probably going to stay very close to 2% over the coming year. And that's one of the reasons why the markets aren't really pricing anything for the ECB. They seem to be happy that they've completed the job in getting inflation back to target. Nothing really more to do. And that's why, as I say, we're looking for no change in rates. But I think there's there is always a lot of information contained in inflation prints because they do provide a heck of a lot of detail behind these. What we're seeing at the moment is, I think there are upside risks and downside risks to inflation going forward, plenty of them on both sides of the docket. But I think the downside risks, things like China dumping into Europe, or the fact that past rises in the currency might be pulling down on inflation, or the fact that some countries like Germany, even though they're spending a lot of money on fiscal policy, they're still looking at levels of output which are running well below trend. And all of that means that there are probably, if anything, downside risks. They're the risks which dominate. So, worth watching out for that over the coming year.
Brilliant. Thanks, George. Well, hopefully plenty more information to come this week, whether it's in the UK, as we said, in Europe as well. But certainly as we look ahead, I think Europe and the UK could be an interesting source of discussion and maybe divergence on rates a little bit based on what you've said and what's in some of your forecasts. So we'll be checking back in with you regularly, I'm sure, during 2026. Thanks very much.
Thank you, Dom.
Well, that's it for this week. Thank you, as always, for joining us on the Week Ahead podcast, produced and edited, as always, by John Dalton. Please feel free to share this podcast far and wide with anyone you think would be interested. You can like and subscribe to Nomura's podcast through all the usual channels, such as Apple, SoundCloud, and Spotify. We'd also be grateful if you could leave us some feedback. Let us know what we can do better or what you want to hear more of as we move into the new year. For more, you can also log into nomuraconnects.com to keep up to date and to hear more on a range of topics. Thanks once again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, One Investment Bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.